Welcome to Chit Chat Stocks. Before we get to this episode, we want to talk about our friends at Interactive Brokers. Interactive Brokers is the professional's gateway to the world's markets. Interactive Brokers offers commissions starting at $0 on US listed stocks and ETFs, with low commissions on other products, and there are no added spreads, ticket charges, or account minimums. Clients in over 200 countries and territories trade stocks, options, futures, currencies, bonds, funds, and more on 160 global markets from a single unified platform. Clients earn interest rates of up to 3.83% on instantly available cash and pay margin rates up to 53% lower than the industry. You can also earn extra income on your lendable shares, and IBKR's powerful, award-winning trading platforms help every level investor succeed, from beginner to advanced, on mobile, web, and desktop. When placing your money with a broker, go with a broker you can trust. Make sure your broker is secure and can endure through good and bad times. We use IBKR here at Chit Chat Stocks for their best-in-class international coverage, and you can too by heading on over to ibkr.com. Interactive Brokers is a member of SIPC.
Welcome to Chit Chat Stocks. On this show, hosts Ryan Henderson and Brett Schaefer analyze businesses and riff on the world of investing. As a quick reminder, Chit Chat Stocks is a CCM Media Group podcast. Anything discussed on Chit Chat Stocks by Ryan, Brett, or any other podcast guest is not formal advice or recommendation. Now please enjoy this episode.
Welcome into another edition of the Chit Chat Stocks podcast. My name is Brett Schaefer, and as always, joined by Ryan Henderson. We have one of our, I've kind of talked about them as a filler episode, but I think this is going to be a high quality concept. We're not doing a stock research report this week. We're not doing an interview with an analyst. We're not covering a super investor. We're doing one of our quarterly roundup ones where we try to look at, a group of stocks that we either own or on our watch list or cover a specific theme. And this time, Ryan came up with a good concept: 4 great stocks that no one talks about, or really that no one has heard of. And the criteria, well, not quantitative, it was basically, is the stock a 100-bagger? And do we have no idea what the company is? Have we heard of the stock before? And we have 4 great choices for you. We're going to use these as case studies. They're not buy recommendations. They're more of case studies to help us learn and identify, hopefully, some potentially 100-bagger stocks at current levels. And we're going to get right into it. But first, I would say if you want to read the show notes, look at some of the charts we've made for this episode, follow us on Substack and get the free newsletter associated with every episode, and give us a 5-star review on Spotify or Apple. All right, Ryan, you're up first. Lithia Motors, company I've never heard of. I hope no listeners have heard of it as well. Take us through their story.
Yeah, I wasn't really sure what my criteria was going to be for this. One piece of the criteria, so the name, 4 great stocks that no one talks about. One piece of the criteria had to be that they outperform the market. And Lithia Motors has done just that. So has the second company I'll talk about. The only other criteria was basically, do I know anything about them? And with Lithia Motors, the answer was no, until actually probably a few weeks ago, I had a conversation with a really talented, bright investor that I admire, and he mentioned Lithia Motors, so I felt inspired to go through it. Lithia Motors is a retailer of new and used vehicles and related services. Basically, they are a serial acquirer of automotive dealerships. They have 50 different brands, 500 different locations across the US and Canada. It's not there's no single brand dependency. They will acquire franchise, like a Ford franchise. They'll acquire a Toyota franchise, you name it. I don't really hear that many people talk about this business, but they have put up phenomenal results for investors. They have beat the market over the last 10 years, 15 years, 20 years. It's been a little, performance hasn't been fantastic over the last 5, so we can talk about why that is and sort of the valuation today as well in a sec. But since their IPO in 1996, they have compounded at 13.5% per year for investors versus just 9% for the S&P 500 over that time. They are currently the largest player in the industry, but still have an estimated 1.5% market share. So this is a very, very fragmented space. There are about 17,000 auto dealerships in the US, and Lithia has gone through that list. They have connections with these dealerships. They talk to the dealerships, try to get some sort of gauge on whether or not they want to sell. They are waiting for the time that those dealerships are ready to sell. It reminds me a little bit of Constellation Software in that way, where there's this huge pool of potential businesses that could sell one day, and they're willing to kind of take the long-term outlook and say, let's build a relationship, be there in their inbox, be there on the phones that day that they feel inclined to sell, and kind of be the acquirer of choice for them. As for the actual existing business model, I'll walk through kind of how they make money, and then we can talk about some of the advantages. But when people think of car dealerships, you probably think of buying and selling new and used vehicles, which Lithia does, but it's actually not the biggest part of their business. So roughly 65% of the company's gross profits comes from servicing and financing. So that's really where the margins are, there's the financing and insurance division where you're helping people afford and insure their car. And then the services is you've bought a used or a new vehicle with that dealership. You already know them. You know that they know your car well. You don't have to go kind of shop around for a new auto servicer. You can just go to them. And usually there's kind of, whatever, like first 5 services, first 5 oil changes are free kind of thing. So they kind of build that relationship with you. And this serves them really well during recessionary periods when people aren't buying as many cars, because people aren't buying as many cars. They got to get their existing cars serviced, and servicing your car is not really something you skip out on, since it's kind of critical to earning an income for a lot of people, getting around. So it's really kind of, even in 2008, they earned like 2% operating margins. Typically it's 4%. So it was certainly hurt, but they're not unprofitable even in tough times. In general, though, it isn't too complicated. They run a bunch of auto dealerships, and do everything sort of a standard auto dealership does.
Right. And you could, for the one word description of this company, describe them as an automotive dealership roll up. I think this strategy just makes sense. You have a lot of family owned businesses out there, you have a lot of family owned dealerships. You can probably buy them and not that too expensive of an EBITDA or cash flow or owner earnings multiple, whatever you want to describe it as. And given their scale, given their operational expertise, hey, it makes sense. And you can see why. Yeah, the business it's probably not the ideal market, whereas a Constellation software in general is maybe a better business model, but these aren't bad businesses. And it seems like, I mean, I was just scrolling through some of those Washington locations behind me, or while you were around me while you were talking. They own a few in the Seattle area, but I know plenty of, I mean, I don't know them personally, but there's plenty of family-owned dealerships around where I live that when the time comes to sell, well, Lithium Motors will be waiting right there for them. And I think it makes a lot of sense.
Yeah, and there are couple distinct advantages to this business model. So for starters, throughout most of their history, they have focused on buying dealerships in rural areas. And those rural dealerships tend to have a local moat, you could say, in that there are literally in their contracts with the OEMs. Like, let's say you're doing a Toyota dealership, it'll say no one else can open a dealership within 100-mile radius or whatever. So you've kind of got like that little geographic moat there. And then there are also kind of the standard size advantages. So unlike smaller independent dealerships, they can centralize the back office functions. They don't have to depend on consumer sentiment for a particular brand. There's like working capital advantages, so they can, by having multiple dealerships instead of a single location, they're able to move inventory around their store base to kind of help optimize certain stores. And then the biggest one, and I'll touch a little more on this in a second, is they don't compete with the typical acquirers. They don't compete with a private equity and stuff like that. And I'll explain why that is in general. But they've got these structural advantages, and they're typically able to acquire these dealerships at around, they say, basically 0.25 times sales, and they generate 4% operating margins. Lithia does across the business. So that typically means they're paying around 6 times expected earnings for those dealerships. And this formula has resulted in just phenomenal earnings per share growth for Lithia over time. If you look out, it looks even better in like 2009, 2008 if you're comping it to that, because there was a down period. But if you look at it since 2011, earnings per share has gone from $2.20 a share to $31.70 a share. So more than a 20% annual growth rate. They've just done really a phenomenal job finding acquisition candidates and allowing them to operate well. They increase volumes typically as well. There's the other scale advantages, like you can kind of put more money into marketing and all that as well. So yeah, in general, just phenomenal earnings growth, and the playbook has resulted in exceptional returns for investors.
Right. And I'm looking at the chart here, Ryan. I'm sure you're going to get to this now, where they're trading at 9 times earnings today. There's some other discussion questions, but if we look at our chart from our friends at FinChat, if you'd like to get that discount, the link is in the show notes. It was pretty steady growth, and then the pandemic saw a huge boost in earnings per share that has now come back down. Did you learn? I know this is kind of the first time we were introduced to the company. Did you learn anything about it? Is it kind of the bullwhip effect of the Carmageddon, and now we're worried about tariffs? What did you find out about this huge earnings kind of boom and bust of the last few years?
I believe they had just a huge surge in new and used vehicle sales, as we kind of, I mean, it got so extreme where people were selling their used cars in some cases for more than they bought them new.
Yeah.
Yeah. Which is so rare.
It was sort of like Ally. They had a huge one-time earnings boost that wasn't sustainable 2020 and 2021.
Yeah, and there were supply chain issues too. So like limited inventory, people were paying just extreme prices. And if you look at like used car prices, I can't remember who's the aggregator there, but it's certainly kind of come back down to earth. And so relative to 2022, earnings don't look that great. But if you zoom out, it's been just kind of exceptional all around. And the one question people always tend to ask with serial acquirers is, if returns on the acquisitions are so good, how come those returns have not been competed away by other acquirers, private equity specifically? And for Lithia, this is really one of their biggest advantages. Dealerships are OEM's primary touch point with consumers. So contractually, the franchisees are actually not allowed to sell to anyone. You have to get OEM approval, which you don't really want to just sell to some private equity company who's going to slash costs, because then they're potentially selling less cars. And so for the OEM or the car brand, it's not that attractive. So Lithia has really become one of just a few companies who is actually able to acquire these dealership franchises. And Lithia has this playbook where they show OEMs, they're able to say, here's how much volume growth we are able to create post-acquisition in our previous deals. And that's ultimately what the OEMs are looking for. So they've got the marketing firepower, they've got the know-how to get customers in the door, whereas a private equity buyer just simply does not. So that's kind of what's allowed them to be the biggest serial acquirer of dealerships so far and generate good returns. Is it hasn't been competed away by private equity for the most part.
Okay, so if this is a good business, if it's grown so much, why is, as of this recording, the PE ratio at 9?
Yeah, I think there's a couple of reasons. Long term, there are some kind of looming risks there's been a rise of digital car buying marketplaces. So even though buying and selling cars isn't necessarily the biggest profit driver for Lithia, it's an introduction to the customer. So the customers that buy from them, they'll also use them for financing. They'll use them for servicing the car down the line. If you strip away that first component, there's risk that it impacts the rest of their business. So Carvana, AutoNation, companies like that have built up these really big online marketplaces have potentially have stolen share from them and potentially could do more so down the road. The second one is the rise of electric vehicles. They just have less moving parts. This could hurt Lithia's parts and services segment, which accounts for almost 40% of their gross profit. Just less need to be serviced. It's ultimately going to be a headwind over time. It'll be a slow headwind, I imagine. It's kind of like the same risk you see with O'Reilly and AutoZone, where people just don't need as many parts, so they're not going to go there as much, but it's going to be a slow grind down, I imagine. And then beyond the longer term worries, overall, I think investors just have concerns around interest rate sensitivity. The big one is that it might impact car volumes, so buying and selling used cars, new cars, all that, but also it'll increase Lithia's cost of capital, and they use a lot of debt to acquire other dealerships. So net debt to EBITDA right now is 7 times. If you're rolling that debt in a higher interest rate environment, potentially it's going to eat away at some of the earnings for shareholders. So
That is high. That is a high number.
yeah, it's now I think the businesses are quite consistent. Like the underlying dealerships are pretty consistent, and the costs are all variable for the most part. Like the biggest cost for them are sales commissions, right? For the cars. So those are generally they're able to maintain pretty consistent profits, or at least there's not risk that they're going to be unprofitable. So the debt seems manageable, but yeah, it's a very, I think that's one of the reasons it trades cheaply. The other one, which is the big question, and I imagine people think about this with tariffs, how do tariffs impact them? Is this like, because obviously automotive companies would be hugely impacted given how much imports there are of cars. And I imagine there's a lot of imported dealerships specifically for Lithia. I think for me, the way I think about it is a good chunk of their profits comes from servicing, right? So I think that part would be resilient. With even in a slowdown, they are able to be profitable, which gives me some comfort. So 2% operating margins in 2008, I think that's pretty impressive, gives me a little bit of confidence. But the other part, in a downturn, they are advantaged relative to the individual dealership that might not have as good of a balance sheet. And I think that could be a share gain opportunity where maybe they're able to kind of press the accelerator and acquire more dealerships than they would in good times because less people are selling when things are good. So I imagine deal flow kind of increases when things turn sour.
Yeah, and it's better to be them than the OEMs, the makers of the actual cars, Toyota, whoever. Yeah, they should do okay, I would guess, unless we see a huge recession and depressionary period where no one's safe. I would worry about that leverage ratio. There's definitely a concern when combined with a potential for an economic downturn, but seems like a good business. I guess when you look at the PE, EV to EBITDA or free cash flow or whatever is going to be higher than that, so it might not be as cheap as what the PE looks like. But if they can regain their footing and get earnings growing again, yeah, seems like it could work here. And it makes sense to me that no one has talked about this company because it itself is not a consumer facing brand. The one thing that just pops to mind for me is that if Carvana is on good financial footing again, that could pose a growing risk for the company.
Yeah, I think it's a long-term concern, but volumes haven't been that affected over it's still like the dealerships themselves still do pretty well. So it's not like the end of the world that Carvana is doing well. Also, the EV to EBIT still reasonable. Like you said, it's a little higher than the price to earnings. I think it's at around 12 times. And so it makes sense that there's the concerns. Analysts that follow the auto industry say this is the dealership's business is the best part of the automotive, I guess, supply chain to own, where you've got the servicing revenue that's quite resilient even in tough times. You're not as susceptible to downturns as the OEMs. Your costs are primarily variable. So you've got just a lot of insulation from big recessions. And they can do all the added stuff like financing and insurance and stuff like that. So I think this, I'm genuinely more interested in this business. I need to study the like risks probably a little more and try to get like contextualize how big the Carvana and AutoNation threat really could be. That's probably the one that's outstanding to me, but they've got a playbook that really works and they're insulated from competition on the acquisitions for the most part.
Okay, let's move on to my first stock, second of the four. Remember, these are stocks that have gone up a ton and have done well, but no one really talks about, no one has generally heard of. And when I mean no one, I mean just the everyday person. If you talk to your hobbyist dad who's an investor, they haven't heard of it. And my company is Jack Henry and Associates. Not a whiskey brand, Ryan, but we'll get to what they do. But let's look at the stock returns first. They have generated a roughly 313,000% total shareholder return since 1990, which would have turned a $10,000 investment into over $31 million in just over 30 years. Well, almost 35 at this point. It has raised its dividend for 20 straight years. Revenue has grown every year since 2005. And yet, Ryan, no one is talking about this. And I ask why? Because it is the technical plumbing for small banks and credit unions, which is quite boring. And I can already hear people falling asleep at the sound of that. Not only is it in a boring area of the market, which are smaller banks and credit unions, it's a boring part of a boring industry, which is managing deposits, information flows, and all the stuff that you really need to get right at a bank. Nobody interacts with the Jack Henry brands in everyday life, and yet they may use a bank that is powered by its processing and back-end solutions. We want to give some rough figures here. They do about $2.25 billion in revenue in 2024, 2.2 actually, and that is up from $535 million in 2005. If we want to look at a quote from their annual report, this is what they say they do. Their core software systems primarily consist of the integrated applications required to process deposit, loan, and general ledger transactions and to maintain centralized customer and member information. These are processes that a bank must get correct. Smaller banks, which don't have, the multi-billion-dollar budgets of a Bank of America or JP Morgan and Chase, they don't have the budget to develop these themselves. This is where Jack Henry's products step in. They can invest in these solutions and sell them time over and over again to thousands of different smaller banks around the country. Jack Henry has a long history of making strategic acquisitions, buying 35 companies to upgrade its product portfolio since 1999. I think this is first time we'll notice a theme in these well-performing stocks that no one has heard about: acquisitions and being good at it. And there are very few serial acquirers out there that can actually do it well for shareholders. There are those that do, and the well-known ones are the Constellation Softwares, the Berkshire Hathaways of the world. They can make a killing for shareholders, and Jack Henry looks to be in this rare mold. Ryan, I think, was showing the free cash flow per share growth over the last 2 decades. It's gone from $0.50 to $7 over the last 12 months. That is a 14.4% annual growth rate. I'm going to get it down to how they make money, Ryan. But had you heard of this company before? And what do you think of the industry?
I have never heard of this company, which for a big business and especially like the compounder cohort of companies, I honestly thought I had known about most of them. And going through this exercise and looking at all these companies told me just how wrong I actually am. And there are a lot of great stocks out there that I've never heard of. This is definitely one of them. I will say, yes, thought this was a liquor company based on the name.
Yeah.
No, it's amazing to me that if you look at 2008 and 2009, which is like Armageddon for banks, like worst possible year. I don't think anything was up for any bank that year. Jack Henry still grew revenue and free cash flow. So really,
You got to process their system.
really
You can't have people not know what their money is, and it has to be accurate.
Let's dig into how they make money. Actually, I'm curious around like I've got some follow up questions and pricing power type questions, but how do they make money?
Okay, so yeah, it like a company that processes payments, they do a lot. They have two separate segments: software and services, and then payment processing. And as you can guess, processing is revenue associated with the payments processing. So as more dollars flow through the system, I believe they have a take rate on that. It also has, debit and credit card, ACH stuff, check deposits, all that good stuff. And when reading through the annual report, we can see here that when they describe their software and services segment, they say it's, private and public cloud fees, which predominantly have contract terms of 6 years at inception. So they sign these software and services contracts. They're long-term deals. And then if we look at their processing revenue, that includes quote remittance revenue from payment processing, remote capture, ACH transactions, card fees, and stuff like that. So that'll grow as deposits and just money that flows through the bank or in and out of the bank grows. Software and services revenue was $1.28 billion in 2024, so 58% of sales, and then 42% was processing revenue at $940 million. Processing revenue has actually grown at twice the rate of software and services revenue in the last decade. And I think this makes sense, given that with inflation and stuff like that, as inflation protected, as more dollars are flowing through the system, they're going to have more and more money that is processed. And I think it also shows potentially some untapped pricing power with the software solutions, where they haven't been egregious on price hikes. Yeah, they probably steadily raise prices, but the fact it's only grown at a few percentage points per year, and it's such a vital part of these banks, because if they try to rip and replace, that's a risky endeavor. They probably can raise prices if they want. I would have a note here of the difference between their on-premise solutions versus cloud revenue. Like a lot of software companies, they've switched to the cloud, and when they break that out, now that makes up the majority of software and services and has grown at a faster 11% clip in the last decade. I like this. Even though they're a pretty old company, they've been able to adapt with the times, at least, maybe a little later than other cloud-based companies, but they've done fine. And it's important for a technology company to, durably grow and do this over the long haul. Here is why, and then Ryan can have any follow-up questions. Here's why I think Jack Henry stock is underfollowed. It's not a brand individual customers interact with. It operates in the back end of an already boring industry. It has not had explosive revenue growth to drive eyeballs. So there wasn't some, this company is growing 50% year over year. I'm going to start writing about it on the Motley Fool. Ryan's going to start tweeting about it at FinChat. Thousands of other people are going to start, hyping up this company. And then fourth, the name of the company does not indicate whatsoever what they actually do. And being underfollowed can be an advantage in long-term stock performance. It allows the company to purchase stock at cheap levels consistently, and it keeps any potential competitor ignorant of the cash cow you're generating.
What do you think has gone right here? What did Jack Henry do so well that created such great returns for shareholders?
Well, they understood, well, at least they got into the right industry where, the last 3 to 4 decades, we've seen the digitization of almost all industries, and the consumer banks, the credit unions, the small banks out there needed to compete with the Bank of Americas of the world. So there's just a growing market out there for these type of products. I also think they've been smart acquirers. They've acquired tons of companies over the years, so the roll-up strategy works well again in this case, similar to lithium motors. But besides that, though, I don't think it's that complicated. No one really cares about this market. Venture capital isn't targeting it. People even don't like the market because the number of tiny banks are disappearing. But the core market that they've gone after, from what I've read, of kind of mid-sized credit unions, mid-sized banks, upwards to I think $50 billion or $100 billion in deposits. That's been fairly steady. And the fact that there's smaller and smaller amounts of these, well, the deposits are growing, and the size, the cumulative size of this business is growing. So I think that's a good thing. I'd say the number one risk is maybe the neobanks of the world, such as I doubt Ally Financial uses them. I doubt SoFi uses them. I would guess, and anyone that knows this company well, this is just an introduction. I haven't done much research on the actual company. Maybe they do use them, but I doubt that they're using these products. But there's a lot. We still use one of the local credit unions in Seattle. I don't know if it was a mistake for us to use them for a company that didn't really require any local expertise, but we did, and we're still with them.
Yeah, it's just like ultra sticky. Like as dumb as it might be, like you can get better high yield savings rates elsewhere. You tend to just stick with your bank. People do. It's just a pain to switch. It makes sense that a regional bank, small, maybe not too small, mid-size, you could even say, obviously don't have the resources to build this out internally, like at least to the ability that Jack Henry provides. So yeah, that makes all the sense in the world.
And it'll cost less for them. Another thing I'll note: market share taker. Good unit economics, as maybe most listeners were aware of, but they have gross margins just north of 40% and operating margins consistently above 20%. And here's what also I think helps with the total shareholder return. Well, not I think it does, is consistent and growing dividend payouts. So if we look at the total return since 1990, it's about 313,000%, but the stock price is only up 173,000%, which would still be good, but it doubles your dividend reinvestment, helped double shareholder returns for this company.
Yeah, it's amazing how so many people think of dividend payments as a restrictive thing where it becomes like you have to give out the dividends to shareholders and because you're kind of obligated to. You don't, I mean, you could technically stop paying a dividend, but people think of it as like, oh, you don't have as much money to invest in new initiatives, or, you know, you could be buying back stock. It seems like that forcing function of we are going to be paying out this dividend, this is the capital we have to work with, always tends to result in pretty good returns for investors, like a better outcome than
stick in your niche. Let's not expand into something stupid. It might work if you're a Berkshire Hathaway, but you're probably not Warren Buffett, so I wouldn't try that. And it keeps you locked in on the consistency. And if you have a good business, stick with it. That's what you know well, and you're probably just going to diversify. All right, Ryan, what is your second stock? How did you find it, and what have its returns been?
All right, folks, before we move on, we want to talk about Blue Chippers Club. Blue Chippers Club was started by two friends of ours with the goal of building a tight-knit community of stock-focused investors. Inside this community, everyone gets to share and break down their portfolios, pitch stocks, receive feedback, and even participate in weekly calls. I truly love this idea, and it's why we're promoting it here on the show. I join the calls pretty much every week, and it's phenomenal for generating new ideas and receiving feedback from other like-minded investors. If you're interested in joining, head on over to bluechippersclub.com and hit apply. That's bluechippersclub.com. The link will be in the description. Yeah, we're starting to see a recurring theme here where roll-ups in unsexy industries can produce phenomenal returns. And I imagine all four of the companies that we're discussing here are market share takers, sometimes by buying market share, like we're going to see with this one, but ultimately it really having a great roll-up strategy can work wonders for shareholders. But there's sometimes where it sounds like a great roll-up strategy and you're not actually getting the synergies that they preach. So you really have to understand what are the benefits of being a part of the overall conglomerate and whether or not it is attractive for acquisition targets and whether or not they're able to actually juice earnings once it's under the hood. My third company, or my second company here, is Rollins, which is a global leader in route-based pest control services for both residential and commercial customers. If that doesn't sound sexy, I don't know what does. To paint a picture of how well this stock has performed, if you would have invested $10,000 in Rollins in 1990, today you would have $1.4 million. That's a 15% compound annual growth rate, keep in mind. S&P, which has been phenomenal for investors over the last 35 years, is doing just 9%. I think did 9.2% annually over the time. So they have crushed the S&P 500 over the last 30 years, I believe tripled the total return cumulatively. And as for the business model, it's somewhat similar to Lithia, where they own a number of pest control brands that are well known within certain geographies. And the customer journey often starts with someone that experiences an issue with pests or termites, or maybe has like a snake in their yard that needs to be removed. They're having bugs, like issues with pests. And most of the time, customers want it taken care of right away. So they will call their local pest control company, which is often a Rollins brand, depending on where people live. And that will become the beginning of a longer term relationship. To paint a picture of some of the brands that are in here, there's one that I imagine most people will recognize, and then there's some regional ones. So Orkin is kind of the big one. They do a lot of national advertising. They've got locations all over the place. There's Crane Pest Control, OPC Pest Services, basically all these kind of big regional players as well. And the process for Rollins is pretty straightforward. They get the call, a technician at one of Rollins' various brands will drive out there. Like, let's say an Orkin technician will drive out there. They'll go assess the property. They will then look for conditions that invite pests and will stop the spread by typically spraying some sort of a chemical. Sometimes it'll be like a trap. Sometimes it'll be a removal, but often it's kind of chemicals to prevent it. And then this one-time visit, which solves an urgent issue for customers, then typically turns into an annual or semi-annual inspection just to make sure there isn't anything that could become an issue later on. So it's usually event-driven initially, and then it becomes recurring revenue for Orkin or whoever the pest control provider is. And for the cost, this is a predominantly fixed cost business. About 80% of the costs, it's estimated for Rollins, are fixed costs. So that's labor, trucks, chemicals, equipment, which they're able to spread across a wider asset base compared to the smaller players. So like Lithia, this industry is full of smaller players. There are two giant companies that lead the industry, Rollins and Rent-A-Kill, which account for 24% and 30% of the market share respectively. So much bigger in terms of market share than Lithia. Like Lithia was 1.5% of the overall industry. Rollins is 24%, but there are still 40,000 roughly regional and local players in their markets where they can go after them and kind of have these bolt-on acquisitions. And as you can probably imagine, Rollins has all the standard economies of scale that work for them. So they can spend more on kind of national advertising. They've got the centralized back office functions, better IT systems, which is huge for route optimization for their technicians. You like the biggest cost detractor, or sorry, the biggest burden to their unit economics is just technicians wasting time sitting in the car on the road. So the IT systems that they've built have been great for route optimization, and they can also spend more money on time training new technicians, which is a huge deal. I know people probably think of this as like, oh, anyone can just go in there and like, get rid of the bugs. They're just told what to do, but it requires a lot of training. You have to know like kind of what you're seeing, how to diagnose it. It doesn't always look the same every time. And they've really invested in this. They have a 27,000 square foot training center in Georgia. And so this is a huge part of their process. And because they have these scale advantages, they're able to make tons of bolt-on acquisitions at attractive prices relative to what the companies could earn under Rollins' umbrella. Just to paint a picture, in 2024, they acquired 32 new smaller players. The big thing here, and I think just the big thing in general with all successful roll-up strategies, is the devil is really in the details. It's one thing to just say like, oh, we're bigger, we have more money, we can spend more on advertising, we have advantages relative to the smaller players, but you really have to do the work to be advantaged. You have to have the better IT systems. You have to have the route optimization. You have to have the training for new employees, the systems to integrate a new company. Once you've really nailed that process, I think that's where the best roll-ups are formed is in those kind of internal systems. And Rollins is really just one of those.
And look at this free cash flow margin. Went from 6% in 2005 to 17% 2025. Not sure if there's any business like change that would have caused this, but it seems like at scale they're getting much more efficient. They're helping these companies convert more of their earnings into cash flow, which is one of the key parts of being a conglomerate. You can get a bit better negotiating, working capital cycles, stuff like that. And look, we want more cash. That's the key. We want more cash coming to shareholders so they can pay it out as dividends or reinvest into new pest control businesses.
Yeah, and some of that has been the shift to more commercial. They've been investing a lot in trying to get commercial customers, which have higher margins and they're very sticky. So, I mean, I think that margin evolution is kind of, you could probably see it coming with the relationships with customers are really sticky. They're in most cases they're recurring. They've got those recurring inspections. It's not a cost that you're going to skip out on, even when times are tough. Like if there's an infestation of bugs in your house, it's not like this month's been tough, I'm gonna just let them stay there. So yeah, a lot of the costs are fixed, like I said, and they've got those scale advantages, so it's really been able to create a lot of operating leverage for them. To kind of sum things up, recurring revenue, which is resilient in tough times, better economics relative to smaller players because of all the things we discussed, high fixed cost and scale advantages created the operating leverage. We saw free cash flow margins have basically tripled over the last 20 years. And this has just led to really strong free cash flow per share, well, revenue and free cash flow per share growth over time. I believe revenue has grown at about 8% a year. Free cash flow per share has grown at, I think, between 14 and 15% a year. So it's just been kind of this perfect formula for Rollins shareholders.
Makes me want to start a roll up, Ryan. What are you gonna roll up? I want to do driving ranges, but I don't know. I always think that's a good idea.
Yeah, I mean, it does. I think everyone has the ambitions to like have a roll up of whatever their hobby is or
Yeah, it
whatever.
sounds fun. Yeah, exactly. Yeah, we're gonna
Right.
get you one for soccer.
But
Yeah,
I mean, people buy multiple sports teams. I think people tend to do that, but that's the point. Is like that's the private equity model, right? They're like, oh, like we like it, we'll buy it, we'll juice the
we got
profits,
the
whatever.
capital. Yeah,
But to be a great roll up, you have to love like building the systems and actually getting in the weeds, and you got to know the business. You can't just acquire it and let it run. Like the underlying businesses have to perform well, and you have to give some incentive beyond just cash typically to the companies you're trying to acquire. But what went right for Rollins shareholders? Regionalization in general, that they're very close to a lot of the customers, which means they don't have to, like, instead of having one larger location in a area, they'll do like multiple smaller ones, multiple smaller trucks, so that you can get to people quicker. They they do the hard stuff really well. I've talked about this at length, but they've created true national brand awareness with Orkin. They have optimized the routes for their technicians. They have built that huge training facility so you don't mess up on the first time you go and assess a house. Because if you mess up and assess the house, you got to go back, and they pay for it. And let's say you did not get rid of the issue, you got to go back. You got to do a free second session, and it becomes kind of like this. You're less likely to become a recurring customer. So they really train their technicians. And then the other one, which is a little hard to, I guess, identify early on, is multiple expansion. This free cash flow multiple for Rollins has gone from mid 20s to basically just over 40 times free cash flow multiple, which has
just start calling it the Constellation Software of X, and then
yeah, I guess
it's the Constellation Software of plumbing. It's the Constellation Software of what is this? Pest control. Yeah,
yeah, you can
that'll
say.
help. That'll help get investors hyped up.
The one big risk, and then we'll move to your second company. The one big risk for me is, we talked about, why has there not been more competition from competitors to acquire companies? In this case, there has been. Apparently, like in 2023, private equity really started to push towards pest control services. And there's actually, if you look up like private equity buying pest control, there's all these articles of like why you should sell the private equity, and written
Written
by
by Blackstone.
written by private equity. I think this is a legitimate risk. I don't think they'll be better operators than Rollins by any means, but it's going to
Crowding out.
drive up the cost of acquisitions for Rollins for new businesses that they're trying to acquire, or they're just not going to be able to acquire as many, would be my guess. So
Nice.
I do think that's a real risk.
This is what the Ivy League endowments are investing in. We're investing in private equity, and what are they buying? Pest control. They probably know so much. Yeah, I mean, this is why Rollins is better. They probably have that local expertise. I couldn't come in and just go, yeah, I can run pest control. You need to know how an industry operates.
My parents have an Orkin annual inspection, biannual, something like that, and there's some really valuable know-how. And okay, there was like bugs that kept kind of showing up, and they looked the same. And the guy came in, and he's like, "Oh yeah, boom, the like stink bugs. Here's how you get rid of them. Where are they coming from? Like he can spray the chemical there. But it's like he knew all this stuff I would have had no clue on. Maybe ChatGPT could have helped me, but who knows? And I just like feel like if you're just pulling out as much cost as you can, like as a private equity operator, your technicians are not going to want to work for you. I can't think of. I would hate to be like like acquired by private equity as like someone that's not higher up. That would just be frustrating because they're trying to strip away the costs at all times. So it just, I don't know. They're not very motivated, not very inspired to help, I guess.
Yeah. Either way, though, yeah, I mean, 40 times, doesn't seem too attractive today, but who knows? It's been a winning company. All right, Ryan, you ready to talk about, which I think this is the most obscure company out there. I don't know. This one might be the winner. I've never heard of this whatsoever.
All right, folks, if you are a regular listener to Chit Chat Stocks, then you know that we use finchat.io daily. FinChat is the complete financial data platform for stock-focused investors. They have robust financial data on more than 100,000 stocks globally, including company-specific segment and KPI data. For example, you want to see Amazon's revenue from advertising? FinChat's got it. How about Netflix's paying subscribers by region? Yep, they've got that too. And they recently added custom metrics so that you can build your own formulas to track the numbers that matter most to you. So head on over to finchat.io/chitchat. All new users automatically get 2 weeks of FinChat Pro for free. But if you want to extend to any paid plans, our link will get you 15% off. That is finchat.io/chitchat. Link will be in the show notes. But it's huge.
Today. But it's huge. It's called Amphenol Corporation. For whatever reason. And since 1990, it has generated a total return of 63,000%. Not as good as Jack Henry, but still would have turned $10,000 into $6.3 million. I think hidden 100 baggers can be found by finding products that are a small part of an overall ecosystem or supply chain, a large supply chain that the rest of the players in the sector cannot do without. And I think Amphenol Corporation is figuratively this and literally this, as a seller of interconnector products for electronics, automotive and aerospace, and industrial use cases. It sells products like simple point-to-point cables, power distributors, sensors, and if you work in automotive plants, science labs, R&D departments, you are probably using some Amphenol products. There will be a graphic in the newsletter that has their end market exposure. We have 24% industrial, 20% automotive, 24% IT, and data centers. And like these other 100 baggers that we looked at here, well, one of them might not have been a 100 bagger, but still, like these other market beating stocks, and this is a trend, 4 out of 4 here. Amphenol has deployed a disciplined acquisition strategy, acquiring 50 companies in the last 50 years, all focused on this one sector. So again, another roll-up that no one has ever heard of. Amphenol's history can be traced back to 1932, when a man named Arthur Schmidt founded American Phenolic Corporation to sell a molded radio tube socket that had better durability than existing products at the time. And as you can see, they've still had like the same idea or the concept of what market they want to go after. We want to be in stuff that connects electronics and basically systems together. In 1957, they listed on the New York Stock Exchange. I mentioned the early history because it looks like the company has been focused on this key niche throughout its history. There has been some acquisitions and some combinations. They, let's see, in the 1970s, I think they were struggling. They were bought out in 1987 by private equity. By 1991, with Koskin in control, they re-IPO'd. And there was actually a big investment from KKR as well, but not really important to the story today. And the last 30 years has been a fantastic time to lead the interconnect and sensor market. Everything is getting increasingly electrified. There's multiple tailwinds to drive long-term growth, and I bet this is what drove their acquisition strategy to work so well. If you buy at a disciplined price, or if you buy it maybe even not so disciplined of a price, if the market is just growing so quickly, you're going to do just fine. I mean, we had fiber optics. The internet and telecom boom has helped feed demand for their products. This continues to steadily grow. We have IT and data centers. Spending on data centers means more spending on Amphenol products. The AI boom is likely helping them a ton. There's the electrification of automotive and aerospace, whether in military or commercial products. These Amphenol products are getting more, cars and plane, trains, and automobiles are getting more advanced and more electric. That is a boom for Amphenol. And then we also have the electrification and digitization of manufacturing. The more we digitize and electrify manufacturing plants, the more Amphenol products are used. Things that came to mind: the debate over automating the ports, the Taiwan semiconductor factories that are getting built in the United States. I'm sure they're using plenty of interconnector products. And when you look at that, it's no surprise to see Amphenol sales steadily growing. Revenue is up. I think this is the IPO numbers. Revenue is up 3,570%. Free cash flow is up 13,000%. Revenue has grown at a 12.3% annual rate since 2005, with only a few down years. Growth is a bit lumpier than Jack Henry, but that is due to the end markets. You can have some down cycles in spending. This isn't software and services. And when you look at it today, is there any reason for this end market tailwind to stop? Amphenol doesn't think so. I mean, for example, you have the electric vehicle market, which is still a decade or two before becoming the majority of automotive sales in the United States. And I would think not even Tesla, which vertically integrates so many parts of its process, is going to build its own connectors. They don't care whether the connectors are slightly higher in price every year. They don't care that they might be charged with a pretty hefty margin, because it's a tiny part of the overall cost of its business. If, for example, something goes from $5 to $10, no one is going to notice, and customer demand is not going to change. But that can be very helpful for Amphenol to keep growing and growing and growing. So maybe I'll stop there before we go into the financials and the stock returns and how they wanted to 100 bagger. But Ryan, I'm guessing you haven't heard of this one. I think recurring guest Sleepwell Capital was the one that responded to my tweet trying to find some underdiscovered gems. Seems like this is a monster business hiding in plain sight. I mean, what's the market cap here?
It's pretty big. I can pull it up, but I
got
actually
almost 100 billion. Wow.
I actually have heard of them recently because our friend John Rotanti follows them, writes about them on
nice. Okay.
his JRO notes page. I hadn't read up on them, and my assumption here was that they were some sort of a pharmaceutical company, because Amphenol kind of sounds like a drug. But yeah, I did not realize what they did. It makes sense that there's been some company that was the picks and shovels provider to just electrification of everything over the last 30 years, and this is clearly the one that it was. I see no reason why it would slow down. Slow down because eventually they'll get too big. But revenue's not going to stop growing right now. If we look at it, actually, there's been a massive acceleration. Maybe I can pull up revenue growth over the last couple of years.
Thank you, AI and electric vehicles, I would say.
Yeah, it's gone from, it grew revenue 21% in 2024, thanks to probably the data center explosion would be my guess. And it's growing really quickly in 2025 as well. So I really like this. What does the multiple look like today? And How has the valuation changed over time? How many, what's investor sentiment like here?
It's probably pretty good. I don't follow it too closely, but the stock currently trades at a PE of 39. If you look at Chris Meyer's recipe for 100 baggers, you don't need, but it's very nice to have multiple expansion. I doubt this is where they traded at in 1995. And it looks like the company is a strategic repurchaser of stock. They were in a large drawdown during the great financial crisis, and they aggressively took out their shares. They're not really doing too much of that anymore while the stock's up higher. And they've had improving free cash flow conversion, because we look at that free cash flow that I mentioned earlier, it grew much faster than revenue since the 1990s. So better cash flow conversion, it opens up the balance sheet to be more aggressive on acquisitions and at a lower cost of capital, or they can return more cash to shareholders. I think this is an underrated aspect of high quality businesses. If we sum it up, here is how Amphenol crushed the S&P 500 and turned $10,000 into $6 million or even higher? I think $6 million bucks. They played in an industry with rising market demands. They made smart acquisitions at a reasonable price. They made smart capital allocation decisions and improved free cash flow conversion, and their multiple went up. If you do all those four things, it is going to be hard to lose money. Now, we're not recommending to buy any of these four stocks today. Maybe someone can do their research further. Maybe we can rank what ones were inspired to research further at the end of this, Ryan. And we can talk about themes as we close out here. We don't know enough about these companies today, and they're likely either out of our circle of competence or overvalued. But using these four examples as case studies, they can help us all identify promising stocks with 100 bagger potential. So maybe let's go through the two topics to end it. First, what lessons do you take away, Ryan, from studying these four companies?
Roll-ups can be huge successes if there is, if the details are all sorted out, if there really are synergies in acquiring companies. Like if you're seeing the acquired companies grow earnings after they've been integrated, and you're seeing the integration process start to speed up, you're seeing a huge area of actual acquisition candidates and reasons to sell, it can be sort of a perfect formula for the best operator there. That's one. I guess other highlights or things to look for would be market share takers. You want to find market share takers. It helps if they're doing it organically, but if they can successfully acquire market share at reasonable prices as well, that works too. And look in unsexy industries. I was actually thinking, okay, the data center boom, we're still seeing this play out. Data centers everywhere, huge investments. There's got to be some picks and shovels providers that are benefiting, that are I don't know, the door stops that they sell to data centers, whatever it is. And I've now seen two. There's this AAON company, which does commercial air conditioning for data centers. They've had a huge jump in their backlog. And now Amphenol, which has seen big revenue growth from it as well. So try to look, I guess, deeper down the supply chain. Don't just look at the big names. Look at who else benefits, and don't be afraid of unsexy industries.
Right. One, if you talk about the data centers, there's costs within their income statement. Look at what those costs could be and who those providers are. The one thing I'll add here is improving free cash flow conversion. I think that was a theme for all of these companies. You have improving free cash flow conversion, that free cash flow per share goes up, and free cash flow per share, as long as you have intelligent capital allocation, that will drive stock returns over the long haul. I mean, a stock at the end of the day is worth the cash it produces for you, the shareholders. All right, Ryan, from a standpoint of not buying, but what one you're inspired to research first, rank these four stocks.
Lithium Motors is probably the one I feel most inclined to research, because I think we saw very similar characteristics of all these businesses, where it's been multiple decades now of great operating efficiencies and just good performance at the operating level, but also successful acquisitions, all that. Lithia to me, seems to have the biggest runway, I think, for acquisitions, where they're only 1.5% of the market. There's 17,000 dealerships in the US. I think there's room for them to gobble up more dealerships. And I like that they're trading at a pretty reasonable multiple, it looks like, EV to EBIT at 12 times. So they would probably be number one for me. I like Rollins was too expensive, and I don't love that private equity is getting involved there and probably making the bidding more competitive. So they might be number four for me. Jack Henry, I don't know if I've ever seen a revenue chart that consistent.
Yeah, it's nice. It's
So
nice.
maybe they'd be number two. So I'd go 1 Lithia, 2 Jack Henry, 3 Amphenol, and 4 Rollins. How about you?
I think I'll put Lithia at 1 because just the price looks potentially cheap. Who knows? There could be some underlying risk here we're not looking at. I'd say 2 Jack Henry because it also kind of comes down to valuation. These all seem like good businesses, but they didn't seem extremely cheap, although I may not have put up that valuation figure. I think third would be Rollins, but Rollins and Amphenol don't excite me too much. One, Rollins, it just kind of seems generally very expensive from an earnings multiple place. And then 4, Amphenol, I worry that, they've seen the benefits of a huge boom and multiple expansion, but again, that can reverse, and you don't make money buying after a boom. You make money buying before the boom.
All right, I think that's going to do it. We want to remind listeners to give us a 5-star review because it's very helpful. That's the best way to help the show grow. Any other parting thoughts, Brett?
I don't think so. Subscribe to the Substack to get the free graphics for this episode. Let us know if you like or don't like, I guess, these type of topics. I think this was very illustrative for ourselves, and I think the listeners will hopefully learn something from this episode, as long as being a title that I think people will listen to. Let's see. Teasing any interviews. We have interviews coming up on Airbnb, Robinhood, and the ticker is ASTS, but I always forget the actual name. AST Space Mobile, which is a very hot stock that I think will be 3 fun interviews. So look out for those. All right, who wants to do the disclosure? Ryan?
Go
You or
for
me?
it.
We are not financial advisors. Anything we say on the show is not formal advice or recommendation. Ryan and I or any podcast guest may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, for tuning into this episode, and we'll see you next time.